Welcome to the Capital News. I am your host, Alex Karitis. Today is March 21st, 2019. Thank you so much for joining me. So we had a turnaround in the markets today. The S&P was up 31 points, or 1%. The Dow was up 217 points and closed up 0.84%, so didn't quite make that 1% mark close for the day. But the NASDAQ did. The NASDAQ closed up 110 points, or 1.42%, so a big day on the NASDAQ. And the Russell 2000, the small cap index, was up 19 and a quarter, or 1.25%. So a big day for the Russell, the NASDAQ, the Dow, the S&P, all of them really. Why? Well, it was in the news. It has to do with the Federal Reserve. Daddy Chairman Powell came to the rescue. The drug dealer came to the rescue. He gave the markets their fix. I mean, we said yesterday the market may have been trying to digest what was said yesterday following the FOMC meeting and the subsequent news conference, and so markets were pretty much trading down yesterday. But I told you we can't expect to look at one day and come up with a trend, because one day does not make a trend, and neither does today. It was a flip-flop. The market regained a lot of its losses from yesterday and really the past couple days. So is this going to be the start of a new trend to the upside because the Federal Reserve was more dovish than was anticipated, that they are not projecting any more interest rate increases this year and only seeing one hike in 2020? We cannot take these people's word for anything, because last year everything was rosy, everything was fantastic, and of course that was in tandem with the president who said it was and is the best economy ever, but we couldn't remove the crutch. We couldn't remove the crutch because the crackheads on Wall Street threw a tantrum in the fourth quarter, and you had to have a 180 in policy. So you cannot trust these people. You can only trust to not trust them. If their lips are moving, they're probably lying. That's how you know they're lying. Their lips are moving. And that's a shame that I have to say that, but that's unfortunately the truth. Because you have a team, I don't even know how many hundreds of PhD economists, financial engineers, whoever they want on their team at the Federal Reserve. They can get on the horn and call anybody and their mother to say, hey, we need some advice on what to do here. Give us some insights. They didn't know what was going to happen in 2018. They didn't see a global economic slowdown. They don't see the data that we discuss here on this podcast on a daily basis and what that means in the near future. They don't know what's coming. And then they throw their hissy fit and they do a 180. Well, who's to say they're not going to do another 180? I mean, are they going to be boxed into a corner? I don't know. I do not know. But what I do know, and for those who have listened to the political podcast, you have to indulge me a little bit because there's overlap a lot of times with economic and political news. And so President Trump was out today attacking the Federal Reserve. And I'm going to get to that in a minute. But I knew that was going to happen. I told you guys it would. He was going to do the Potomac two-step. He was going to try to dance and weasel his way around taking ownership of this stock market and ownership of this economy, and he's going to play the blame game to do so. As opposed to just leveling with us, the American people, from day one, as he was talking to us when he was candidate Trump, he wants to take praise for everything until he doesn't. And I think he's coming to the realization, just like when he was candidate Trump, that things ain't as rosy as he wants them and wants us to believe. So I'm going to get to that in a second, what I mean, but I want to continue with some of the news in the market. Oil, gold, and the silver, little changed. However, the dollar did regain a lot of its losses from yesterday, which was surprising. Now, I did say that I anticipated the dollar would strengthen. Again, I didn't expect it to do so to the degree that it did so quickly, but it has. My rationale behind the dollar strengthening over the longer run is because the rest of the world is, in my opinion, in more trouble than we are, or at least those are more likely, in my opinion, those will be the dominoes that fall first. Because we already know that Italy is in a recession. We know that Germany just skated by one by the skin of their teeth and quite possibly are in one. Again, you don't know you're in a recession until the numbers come out. And that could be a few months before those government figures come out and say, oh, well, we got negative growth here for this quarter. Is there going to be back-to-back negative growth? So you're already in one before you technically know you're in one, because you have to wait for the government data to come out. In addition, you have a continuing unraveling, and the soap opera continues in regards to Brexit. And again, I had this conversation on the previous podcast, so you have to indulge me if you're continuing to listen here. Brexit, there was some more breaking news this evening because Theresa May was in Brussels talking to her EU counterparts to try to get an extension. Well, she got one, but not as long as she wanted. She wanted to go until June 30th. The EU said, nah, you get till May 22nd, because May 23rd is when the EU begins their parliamentary elections, and they pretty much are saying to the British people, we want you out of here. You got to come up with a deal. That would be fantastic. You come up with a deal. But if you can't, and you can't agree with what we're coming up with here next week, then it's going to be an even shorter deadline, and you're going to have until April 12th. So the next dates that you have to be aware of are April 12th and May 22nd, depending on how British Parliament maneuvers tomorrow and next week and how they vote and what happens. But stay tuned, because that's going to have ramifications, not only politically but economically. That's why I talk about it on both podcasts. And we're seeing the pound starting to take a hit. So the British pound took a little bit of a hit today because the market is starting to factor in an increasing probability, not a certainty, obviously, but an increase in the probability that there will be a no-deal Brexit. A no-deal Brexit. So that hit the pound, and of course the weaker pound sent the British stock market up, which is kind of the same thing that would happen almost anywhere. A weaker dollar tends to signify and signal to the markets to increase. It's part and parcel why President Trump, during his CPAC speech, wanted a weaker dollar, because he wants exports to increase and be more attractive relative to other currencies, and that would just stimulate larger companies, and thus you would have typically higher stock prices. So that's what we're seeing. So that's not a disconnect. That's no surprise. But again, the soap opera continues. We have to pay attention because it's going to move markets. This is one of the things that may be, quote unquote, dampening all of this economic miracle that's just waiting to unravel and shoot us higher and higher to new and ever new highs. So this is just one of the things that can potentially get checked off the list. So it's either going to be done in a few weeks or it might go a couple more months. Stay tuned. It's unbelievable. The VIX was down 2%. 10-year Treasury was up very slightly, still lingering around 2.54%, so we're still there, and I'm going to get into that a little bit. And as I just discussed, the dollar regained some of yesterday's losses. So there we have it. Again, yesterday, a trend. A day does not make a trend, and today, a day does not make a trend. We have some conflicting signals, so we're just going to stay tuned, see what happens. How does the market react? Do they look at the more dovish tone from the Federal Reserve? Do they look at that as like, oh, okay, yeah, that's our hit, that's our crack. We got some more heroin here. We're gonna have, a great time because of this. Or are they gonna say, whoa, wait a minute? Are they gonna wake up and say, whoa, more dovish? I thought everything was fantastic. Oh man, I don't know. Maybe we have to sell off. Those are the rationales. Who's gonna win? If there's more buyers, then the buyers get it. If there's more sellers, then the sellers get it. I can't tell you what's going to happen. All I can tell you is what will ultimately happen. I just can't time it. It's a fool's errand to try to time the market. But nevertheless, you can still do things in the meantime to prepare yourself and to protect yourself, maybe to get into more cash, more stable securities, whether that's government bonds. I know it's a little wishy-washy, but at least for the time being, it will probably be seen, Uncle Sam, and U.S. debt as a safe haven, as it typically is. Maybe some really strong corporate bonds, if you can find them. I think some of the major oil players, such as ExxonMobil, Chevron, Royal Dutch Shell, I mean, those guys they're making money. They're making money. Even though we have oil that was down and depressed prices late last year, it has rebounded nicely, and they were making money last year. They're definitely making money this year. So if you need to park your money somewhere safe, look at those guys. Because the stocks, I just don't know what type of upside we're going to get, and is it worth the risk? That's what you have to ask yourself. That's what I ask myself. I behave according to my risk profile. You have to behave according to your risk profile. But be prudent, be cautious, and don't make any rash decisions. One day does not make a trend. So pick your spots if you trade this market, and if you're a long-term investor, figure out where you want to be overweight, where you want to be underweight, and act accordingly. That's all you have to do. I mean, panic does not do anybody good. So have a plan and stick to it. That's what I advise. Now, getting to some of the Trump versus Chairman Powell and really the Fed in general. The president is going to be having an interview with Fox Business's Maria Bartiromo, and here's just sort of a little bit of it. So President Trump says the economy would have grown over 4% instead of 3.1% if the Federal Reserve had not raised rates during 2018. He adds that he does not care if he, quote, influenced or not the decision to pause on rate hikes. Does not care. We know this. But Bartiromo pushed him further on this and asked the president if he influenced the Fed's decision to pause on rate hikes. I don't know. I mean, look, I hope I didn't influence, frankly, but it doesn't matter. I don't care if I influenced or not, end quote. He doesn't care. He doesn't care. I don't know why he has to talk out of both sides of his mouth. We know he cares. He wouldn't mention this stuff if he didn't care. He cares. He cares greatly about it because he owns this stock market, lock, stock, and barrel. And I told you he was going to do his two-step, and he was going to try to dance his way around this and put blame on the Federal Reserve. And this is how he figured out he was going to do it. Love or hate Trump, the man is good. He knows how to maneuver. He ain't no dummy. This is not his first rodeo. He's 70-some years old. He knows his playbook, and that's what he's sticking to. He is going to blame the Federal Reserve. Look, I'm fantastic. I'm the best. I give you 3%. Obama got you 1%, 2%, maybe. I'm getting you over 3%, and if it wasn't for these idiots down on Constitution Avenue at the Federal Reserve, it would have been 4%. So we got to do something about these guys. That's his argument. But for the Federal Reserve, it would have been fantastic, even greater than what it is today. And believe you me, he will convince most of his followers to stick with that. And believe it or not, I'm okay with that from the standpoint of I want the Federal Reserve to be abolished and the Fed. So at least if he's waking people up, even if it's not in the most sound way of having a really adult education, I mean, I don't think I get too heady on this program with anything. I really tried just to talk in layman's terms as to how the Federal Reserve operates, how it trickles its way through the economy, and how everything is interconnected. It's really not that difficult. It just isn't. And the president speaks in very easy terms, in easy language. I think that's part of his appeal, why he appeals to a broad audience. He doesn't use a whole bunch of vocabulary that throws people out the window and they just can't follow him. I mean, he talks to the everyday man, and that's a good thing. So I don't think he has to say it like this. I think he could really have a further conversation where he can truly educate the people as to why that might be the case and why the Federal Reserve has done harm and continues to do harm to this economy, why it's a bubble. We had candidate Trump doing it. I was singing his praises as candidate Trump, and I was telling my friends and everybody, I was like, you know what? If you read in between the lines, because he didn't say this all the time, this obviously was not his main theme throughout his candidacy. It was build the wall. It was, drain the swamp. It was these types of easy messages. He's going to shake everything up. It was the Supreme Court. But every once in a while, if you listen and read in between the lines of some of his interviews and some of his just off-the-cuff remarks about the economy, the stock market, and the Federal Reserve, I was like, this guy might be, a closet libertarian. He might be, because you don't really just say these types of things unless you believe them. So now I go back and forth as to what President Trump is saying. I mean, is this just something he overheard and he was reiterating it because he thought it sounded good at the time? Or is this something he actually believes? Because when he was candidate Trump, he was like, it's a bubble. This is the biggest wealth transfer in the history of the world. It gives the middle class nothing. It screws them every which way but loose. They have nothing. There's no savings. If you're on a fixed income, you have nothing. People who are retired get nothing from this policy. But people like me, people on Wall Street, wealthy individuals who own a lot of financial instruments, they're making out like bandits at the expense of people on fixed income and blue-collar workers in the middle class of this country. Right on, Trump. I was with you 100%. Now he becomes president, and he wants to take ownership of everything. A bad move. Bad move. But that's what he does. This is what he likes to do. He likes chaos. He doesn't need to do this. He doesn't need to bring the American people into it this way, but he has. So I guess I'm arguing more against style here, but if people can really start to start chanting "End the Fed." Oh, beautiful, beautiful. Couldn't really ask for anything much more, because I told you, if you want to solve the problems that we have, you have to strike at the root, not the branches. What's the root? Got to get rid of the income tax. Got to get rid of the Federal Reserve. You have to start there. If you don't, you're just a joker, as far as I'm concerned. So is the president, is he going to start pivoting here? Is he going to start putting more blame on the Federal Reserve as we continue? Because the Federal Reserve reduced their forecast for GDP for 2019 and 2020 both. What's the president going to do about this? What's he going to say about that? Is he going to lay this at their feet and say it's all the Federal Reserve's fault? They shouldn't have done it. Shouldn't have done it. They should not have increased interest rates as many times as they have during 2018, because we would be even better. We got to pay attention to what the president's rhetoric is going to be, because is he going to say, I don't know, unemployment would be at 3% as opposed to 3.7? I mean, we got to get these jokers out of here. That's what he's going to do. He's going to do something like that, because he has to dance his way around this, because it's just not economics, it's political. You're going to have crazy Bernie, Pocahontas, and all the other lunatics on the left coming out of the woodwork, and if this thing turns down, they're going to start blaming Trump. Why? Because Trump took ownership of it. So Trump's going to say, oh, it's not me, hot potato, it's the Federal Reserve's problem. He will be effective in making that case to his base. He will be. He just has to make it articulate enough to get not just his base, but people in the middle, and even some people on the left who just don't want to go to the lunatic fringe because they're not there. A lot of those blue-collar workers in the Rust Belt who voted for Trump. He's got to get to their level, has to explain this stuff to them. And if you're looking for a more in-depth understanding of what all this means, you can check out my book, The Cynic's Guide to Investing. I had to plug that. But it's the truth. You check it out. It gives a good example of what the Federal Reserve is, its history, fractional reserve banking, all that stuff. And I'll get to that in this podcast eventually, and some other videos on YouTube with some visuals so you guys can have a better understanding of that. So stay tuned for those things. But this is an interesting topic, because this is the root of the problem. Who wins is the question. I hope it's us, the people. And in this case, I hope it's the president if he's actually going after them. I don't want the funny money. You don't either, because it throws a whole bunch of distortionary effects out there, and this is why we have the problems that we have. And until and unless this market corrects itself, it's just going to get worse and worse. The bigger we make this problem, the bigger the correction will be. Now, in regards to the bond market, and particularly the Treasury bond market, I want to continue some of the conversation in regards to the 10-year and the 2-year, which goes to that yield curve. Remember the difference between the 10-year and the 2-year? If that turns negative, then we have an inverted yield curve. And so I have before me here a chart of some data here in regards to the 10-year and the 2-year Treasury notes. Going back, let's see here, back to the mid to late 1970s. So over this course of time, we have 5 recessions. And prior to each of these recessions, the yield curve became inverted. So again, the yield curve is a great predictor of oncoming recessions. Again, it's not tomorrow. It might not even be next month, the next 6 months. But it is coming according to this indicator. And I do put a lot of weight on this indicator. And I believe you should too, because the bond market, again, that's the adults in the room. These are the expectations of what's likely coming in the near term, and near term is usually 1 year or less, and that's typically what happens. You have an inversion, you have a recession within the course of a year. How severe? Well, that's contingent upon how much junk and how much malinvestment is in the system. Right now, we got a ton of junk and malinvestment in the system because we didn't cleanse ourselves fully during 08-09. We just kicked the can further down the road and really went, balls to the wall, and we just put the pedal to the metal, and that's where we are today. And now we have the Federal Reserve that's like, okay, well, we'll just stay where we're at, and quantitative tightening is going to come to an end. What happens after that? Are they going to lower them? Are we going to go back to quantitative easing? Kick the can further down the road? It doesn't matter what country you're in, folks. We talk about it on this podcast and on the geopolitical podcast all the time. Everything just gets kicked further and further down the road. So pay attention to the yield curve. I most definitely am going to stay on top of it because it's an important indicator. Again, it's not the only indicator we look at, but this is an important piece of the puzzle. This has a lot of color in it. This is not a piece that is part of the frame. This isn't the heart and center of it. There's a lot of color, a lot of detail in this piece of the puzzle, so we have to pay attention to it. Another thing I want to talk about is in regards to a follow-up on corporate bonds. And in addition to that, I also want to talk about commercial and industrial loans. So really, the whole kit and caboodle in regards to the corporate debt landscape. And this has to deal with non-financial corporate business. So we're not talking about banks and insurance companies with this stuff. We're just talking about everybody else, okay? So in previous discussions, I had informed everyone that if you just look at the corporate bond market, if you go back to 2008 and 2009 pre-crisis, we were about $3 trillion in corporate bonds. We are now over $6 trillion, okay? Over $6 trillion. And as we sit here today and I look at the graph, we're starting to sort of crest. We're starting to plateau a little bit. That doesn't mean that we won't see a return to the upside in corporate bond issuance, but at least for the time being, we're starting to plateau a little bit. So we got to stay on top of this too, because this is another piece of the puzzle that we must pay attention to. I don't think this is necessarily as important as the yield curve, but this is a catalyst, remember? So we must pay attention to this to see if it continues to plateau or if it reverses course and goes back up to further issuance, which means we're going to be $6.5 trillion, $7 trillion, whatever. Now that's a lot of money, but nothing's stopping it right now. Nothing's stopping it, especially with easy money again, with a more dovish tone coming out of the Federal Reserve. Now, in addition to the bond market, because we had a discussion on that previously, I wanted to add into the mix commercial and industrial loans, which those are now over $2 trillion. Over $2 trillion. So if we take the corporate bond market, which is over $6 trillion, and the commercial and industrial loan market right now, which is over $2 trillion, we're almost at $9 trillion just on the corporate side of things. And again, this is non-financial corporate, okay? So if you're looking at $9 trillion, you then look at the U.S. economy in terms of GDP, and you're talking, what, $18, $19 trillion in GDP versus a $9 trillion debt load on the books of corporations? Half of the economy is in corporate debt. That's crazy. That's crazy. I'm going to have to do another podcast on this. I'm going to graph this stuff. I'm going to have to look at it in terms of GDP. I'm not going to be surprised if this is some sort of record, which again is not a good record to be setting, because this is a catalyst. We have an economic slowdown. And you also have to remember real quickly is these commercial and industrial loans, some of these are loans on top of loans, which would be classified as leveraged loans. This is not good. Now, these corporations, these aren't the best of the best we're talking about. This is everybody. This is everybody. So yeah, you might have somebody that's stamped AA, because there's probably not too many, if anybody, that's stamped AAA, single A, triple B, and then there's junk. There's a lot of junk in here, and we've had that conversation previously. $700 billion in investment-grade bonds coming due in 2019, and then you have a wave of multi-trillion-dollar corporate bonds coming due, investment-grade and junk, 2020, 2021, 2022, and 2023, and then it really starts to taper off thereafter. So you're basically talking, the 10-year bonds from the Great Recession, once everybody started to take the funny money, the easy money. So it's coming due. The piper once paid. He's going to get paid. You can't kick the can that much further down the road, although I do think in large part that's the Federal Reserve's calculus on keeping interest rates low, because they want to allow corporations to continue to kick the can down the road. It's not good. It's not good at all. So what are these corporations going to do with this money? Are they going to continue the financial engineering with share buybacks to increase their share price in turn, which will increase the salaries and the wages of the corporate executives and the members of the board? I mean, the good old boys club, back to it? I mean, not good. Not good at all. There's no question that a lot of this money went into capital expenditures, building plants, hiring people, investing in new software. No question about it. But where did a lot of it go? Well, we know it went into share buybacks. We know this for a fact. We know it went into dividends in attempts to bring people into the stocks. what happens when you have to pay the piper? At the same time, you have a slowing global economy and a slowing economy here in the United States of America. What's going to happen? Your sales are going to drop. Your costs are increasing because now you have all of this debt load that is now due, and you have wages that are increasing. So now your profit margins are going to get squeezed. So this is the next thing that we really have to start paying attention to, because we're already near the end of the first quarter. So we're going to really start having earnings reports coming out at the end of this month, through April, through May. I talked about the blackout period with share buybacks because corporations are not allowed to buy shares during this time frame, which, insider trading and all that stuff. So that makes sense. So it's going to be interesting to see what the catalyst is going to be to propel this market to the upside over the next month or so, because you have to remember that old saying, sell in May, go away. So we'll see what happens there. So we're going to pay attention, and then we have to pay attention to the earnings reports to see what happens with margins. Not just top line, revenue, sales, bottom line. We have to pay attention to the margins. What's going on? Are they getting squeezed? Because if they start to get squeezed, what are they going to try to do in order to maintain those margins? Well, one of the first things they do to cut cost is they start laying people off. And again, when you have unemployment at these lows, even though they are historic decade lows, where do you go? If you're at the bottom, the next direction is up. Just like if you're at the top of Mount Everest, the only way you go from there is down. So you got to start paying attention to this stuff, because once you start laying people off, then it starts to become a self-fulfilling prophecy of an economic slowdown because people aren't working. They don't have that income coming in like they used to. Honey, we got to cut back on some things. Makes sense. And so margins get squeezed even further down the line. Those people get laid off, and the cycle continues until there's that full-blown correction. Corrections are needed. They are a healthy part of a healthy, functioning system. We have to get the quacks out of the operating room. Thank you so much for joining me today, ladies and gentlemen. It has been a pleasure having you as always. Please like, share, subscribe, get the word out. We'll see you next time. This is the Capital News. I am Alex Karitis. Godspeed.